So this was CRM, and it actually had all three trends going into its earnings announcement. So you can see trend one is pre-earnings. Trade one would be trending into earnings date or earnings release. So what you'll see is your volatility increases. So here's the implied volatility, that kind of blue line. And so you can see it's trending up. So again, as a stock approaches its day of announcement, there's that uncertainty building. So, buyers come in for calls and puts, and the implied volatility gets pushed up on that. So when we look at the price of an option, it comes down to implied volatility. So implied volatility, if it goes up, that increases the price of your options, and also then the delta. So you can see here the trend is trending higher. So in this example, you're getting a nice increase on the options of this option series where the earnings announcement is. You're getting the price moving up, which is increasing the options, but you're also getting implied volatility pushing up, which is also increasing those option prices. So that's a really good one to look for, that pre-earnings trend trade. And then once you get to the announcement date, you want to be flattened out of this trend trade. You want to exit that, and then you want to set up the next trade would be a non-directional trade. So this is a trade where we can sell the volatility. We can take advantage of that increased volatility. We can do trades for potential spikes up or down and take advantage of that kind of scenario from different stocks and what they present us. So that would be trend trade or trade two, earnings release non-directional. So again, those crazy earnings, we don't know a lot of times if the market will spike up or down. So we don't really care though if we do the right option strategy. And then trade three is your post-earnings trend trade. So again, in this example, CRM tends to trend in the direction of its earnings. So if the earnings come out positive, it tends to have a tendency post-earnings to trend higher. If it's negative, it trends lower. So you can see after the earnings release here, volatility collapses, but then you get that post-earnings trend trade. So these are three different types of cycles that you can look for, to take advantage of. So it offers some really great opportunity. So here's another example. Here's Nike heading into its earnings, and you can see in this example, it's going to have earnings here was on the 20th of December, and so you can see that actually price was trending lower in this example, but look at the implied volatility, so it's trending higher. So that's one opportunity, that post-trend trade down, and then that volatility crush. You can also see Nike here. Again, it was trending down and implied volatility was trending up. So those are things that you can look for.